Hey, it's Richard with Matthews Wealth Management. We're going to be covering October 2022's asset class performance. October was a pretty good turnaround. It's almost mid-November now, and we had a really big day yesterday as far as low CPI. So take this as kind of a historical thing. And with that, I'm going to do a lot more history over the year and just kind of track what's been happening here. So we don't have a whiteboard, so spent some time doing PowerPoint. I hate PowerPoint, but bear with me. It gives us the opportunity to kind of look over kind of what we've been doing in quarterly reviews. So if you're a client, and I've already met with you this quarter, this is very familiar. If you are a client that I'm going to see next week in North Carolina, this is the cheat sheet, and might save some time in a meeting, probably not. But anyway, for year to date, we're looking at NASDAQ, right? So from January until today in November, there's yesterday's big spike, but we're still down roughly 30% year to date in NASDAQ, which is interesting. And I want you to pay attention to June through August here, this bump, if you will. That's something that's been driving me crazy, but is decent for client accounts. If we go over to S&P 500, we're not down 30, we're down 17, 18%, right? Still have this big bump from June to August. Still is downward trajectory, but this is how the year has fared for everybody. Normally, if this is risk, right, you're looking at an S&P 500, which is kind of aggressive, full-on risk, you would expect a moderate portfolio to be, 50-50 stocks and bonds, and that should be the safety, right? So instead of being down 17.5%, maybe you're down 10 or 12, and unfortunately what we see in a moderate is we're down the same amount because of interest rate risk. We saw this all along. Still got that bump. This is all about interest, federal funds rate as to what the Fed's been doing this year. So that all in all is interesting. The difference, and you still see this bump of where I'm most frustrated was last September, we pulled a lot out of bonds. We went heavy into commodities. Same thing kind of continued through our reallocation in June. And here we have a commodities fund. PDBC would be the ticker here. So from January to June, we were up 50%. Things were looking great. I was telling everybody in the world I told you so. And then we had strategic petroleum release, as well as this constant hope of a Fed pivot. And what that means, if you haven't been keeping up, is a pause in interest rate hikes, a lowering of interest rate hikes, which is yesterday, or actually rate cuts, which, yeah, right, it's not happening. We got actual systemic inflation, but since that correction, that crash of commodities, we've walked sideways, which is just frustrating for me. It's this optimism where people sold out of commodities to jump back into equities, and even though we're up 25% on that call year to date, should have been more like 50 or 70 even. It's just very frustrating from my end. But let's cover asset class performance. That's the whole point of this. If you recognize this from the whiteboard, we have our large cap value, core growth, mid caps, small caps, etc. The big winners are value, right? The value play is up 13, 10, 12, or actually 13, high single digits and mid single digits for the growth side of it. And again, October 2022, you'll be watching this in November, obviously, so it's a little bit different, but we kind of forgot what happened in October, and it was a big month for equities. If we jump into international, international is one of those kind of growth worlds. Wow, big difference with emerging markets. And again, that as we've been playing forever, is a currency hedge that we're looking here. A -3, that's the strength of the dollar, kind of reversing already in the month of November here, but very negative correlation between international and emerging markets. Jumping into bonds, short, intermediate, longs, again with raising interest rates, 75 basis points on the horizon in November as what happened. Everybody was selling off, expecting higher yields to come, which I still think is coming. But long term is the biggest sell-off, especially 3.7%. Tips positive, high yields positive. I think there's a lot of risk to come in the high yields, but it's nice to see tips doing what we wanted them to do. Moving into commodities, we have oil. Huge month for oil. Strategic petroleum release. You got Russia cutting. You've got OPEC cutting. U.S. is exporting. That's where all of our positive GDP came from to offset the contraction. Gold down. Go figure still. Real estate starting to bounce back up. And again, this is very geographically based as to whether you're up or down in real estate, residential as well as commercial. Lastly, we'll cover the index here year to date as of the end of October. The first ones I showed you were live as of today. But year to date through October, NASDAQ down 30, S&P down roughly 20, moderate 17.8. And as a practice, we're down only 12. Very happy about that. People seem to not realize that's 18%. Every million I'm managing, that's 180 grand that would have disappeared between that and NASDAQ. So again, that's what professional money management is for. If we don't dig a hole deeper than everybody, then it's easier to get back out. And as you compound that difference there over a long period of time, super thrilled with the lack of loss that we've seen, and that was from commodities. So I expect that to continue. Got some reallocations coming up here soon. We'll do a separate video to talk about those changes that we're making, but that is the month of October as far as asset class performance.